What we mean by alternative strategies on a very fundamental basis is not about style, classification, or strategy. What one person decides to call himself, I'm a hedge fund or I'm a long only guy. That is not how we think of alternative strategies. What we think on a much more fundamental basis is how do you make money? The risks that you are taking in the market, are those different risks than the risk a long-only equity or a long-only credit manager takes. So alternative strategy for us is a manager trying to extract return from the market by taking risks that are fundamentally different than the risk that you see on the rest of your portfolio, like equities or bond or credit. Alternative strategies can help protect against downside risk in a multiple different ways. The first and very fundamental way is if it is truly alternate, where it is sourcing the risk from a different way from the market, it will not go down at the same time when your equity portfolio or bond portfolio is going down, so long as what you own is truly alternative, not a sneaky beta within your alternative portfolio. Second, if you look at all the other asset classes, the traditional asset classes, equities, commodities, credit, they have all, after GFC, they have become very correlated. So they don't really provide you with a protection. Alternative strategy offers you lots of different ways to provide you with that tail protection. So one thing we do for the two funds that we work very closely with Advance on is to provide that long volatility exposure. Because consistently, when markets go through extreme stressful times, that negative tail protection, there are very few things that offer that protection except things like long volatility. So being able to understand why something should help your portfolio and being able to implement that in a consistent, rule-based, non-emotional way is a way alternative strategies can help clients' portfolio to manage through the tail risk. So to your point about mergers and acquisitions, the return that a merger arbitrage, that is what the strategy is just technically called, that strategy extracts from the market is taking a risk that the deal will close as announced by the parties. Now that risk is very different than the risk from owning traditional equities. If you look, in fact, over the last 15 to 20 years, the average beta of merger arbitrage strategies relative to equities is very low. It's about 15%, with a positive Sharpe of about 1.3, about 8% return with 5% volatility. Now, just because those managers offer that type of return profile, positive return and low correlation to equities, while they are actually trading equities, does not in some way mean that that is all skill. The way we think, what that really means is that that is a different source of risk that managers are extracting from the market. Another quick example could be trend following strategies, which are purely price momentum strategies. They are based on a lot of academic research that says prices tend to trend in normal times as well as in very stressful times. So what these strategies do, again, they don't have a directional bias to be long or short risk, but they let the market dictate whether they are long or short risk. Again, a carefully combined combination of these strategies, which are well thought out, which are again tested against where the market is, we think provides a very good different source of or alternate source of risk for clients' portfolio. And by adding them in a client's portfolio, they make the client's portfolio much more efficient than it would be without having these risks in their portfolio.